Indian equities came crashing down on the bourses yesterday as the Reserve Bank of India announced a surprise rate hike. In an unscheduled address, RBI Governor Shaktikanta Das announced a 40 basis point increase in repo rate to 4.4%. This was the first rate hike since August 2018. Besides, the RBI also raised the CRR or cash reserve ratio by 50 basis points to 4.5% in a bid to suck liquidity out of the system. Today's rate hike, along with April policy's decision on the standing deposit facility, makes the effective rate higher by 80 basis points. Thus, along with a simultaneous CRR increase, the central bank will withdraw liquidity to the tune of 90,000 crore rupees from May 21. The move sent equities into a tailspin as investors had priced a repo rate revision only in the June monetary policy review. The S&P BSE Sensex tumbled 1,307 points to close at 55,669, while the Nifty 50 dropped 392 points to 16,678. The Nifty Bank Index, meanwhile, fell 2.5% to end at 35,264. In the money markets, 10-year government bond yields jumped nearly 4% to 7.3%.
Of course, this is a mid-cycle sort of announcement. So therefore, that sort of surprised the market a bit. Otherwise, the market was on its own track. So that is one. Second, probably even if there was a hike, people would have probably expected 25. So it was 40. So there was a bit higher. And of course, coupled with CRR. But I think they keep saying that they will continue to have their commodities down. So therefore, on the whole, I think it is just that there was some element of surprise in this. That is where the market is tanked. But I think market will probably, come back to, will accept this because, if not today, it would have probably happened probably a few weeks later. But, there was something certainly on the works and the market really expected this to happen anyway. So, but just that it was sort of preponed and it was sort of done out of turn. So that is why the market was probably a bit perplexed. But I think things will come back to normal quite pretty soon. I think this can be easily absorbed by the economy.
Analysts feel rate-sensitive sectors like banking, NBFCs, automobile, and real estate may remain choppy in the near term as a sudden increase in interest rates signals an imminent end to the all-time low interest rate regime, which has been one of the major drivers for credit revival across segments. Going ahead, it could be a bumpy road for the markets as they have broken their immediate support levels on the tech charts.
In the recent trading sessions, we have seen benchmark indices Sensex and Nifty trading in a broad range of 58 to 56,000 for Sensex, and for Nifty it was 17,500 to 16,800 levels. The announcement of raising hike by RBI on Wednesday spooked a negative downside wherein both the indices breached their lower levels of the broad range. We close on a negative note. However, subsequent days opening becomes a crucial indication for the trend ahead. For the Sensex, if we open under 55,000, then we could drift towards 54 and can see even lower levels. Similarly, for Nifty, if you opens under 16,500, then we can drift to 16,300 to 16,100 levels. However, if you have a flat opening or opening with minor losses, and if both the indices manage to trade within those opening range for say 30 to 40 minutes, then we could definitely see a rebound within this broad range.
Thursday's trading action will also be clouded by investors' assessment of the RBI policy action and the weekly FNO expiry. That apart, the US Federal Reserve's interest rate decision will also guide the indices today. Moreover, LIC's 21,000 crore rupee IPO may also move participation away from secondary markets. At the end of day one, the mega public offer was subscribed over 60%, driven by policyholders and employees. Their portions were subscribed nearly 2 times and 100% respectively. Retail investors' quota, meanwhile, was subscribed a little over 50%.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.